the monetary policy is to blame for this deposit crisis. And I think it is vastly overlooked that the inverted yield curve and the destruction of dollar liquidity via the quantitative tightening program is the underlying root cause for this deposit flight or this deposit crisis. It is currently calm before the banking storm, but we are slowly but surely moving from a deposit crisis to a credit crisis in the banking system. Steno Signals starts right now. Hi, everyone, and welcome to this live edition of Steno Signals. Today, we will spend some time on elaborating on the potential timeline ahead for the banking crisis, which currently seems like an idle issue in the US system. But if we look beneath the hood, I think we see more and more worrying signs of an upcoming credit contraction. And I'll show you why in today's show. Please leave questions and we will address them towards the end of the show. 42 billion. That is a magnificent number, but also a number that will change the life of the US banking system for good. This was the amount of deposits withdrawn within probably less than 24 hours of Silicon Valley Bank. And this is, in my opinion, the most extreme bank run in modern history. It also goes to show that the era of digitization has led to a different world for banks when it comes to the stability of deposits as a funding source. So I don't think we should underestimate the importance of the severity of this bank run against Silicon Valley Bank. The deposit crisis will slowly but surely turn into a credit crisis as a consequence of banks taking conservative credit decisions on the back of this deposit flight. So let's have a look at the three stages of a bank crisis. I essentially think that we have now passed stage number one. And the initial outset of the crisis was this deposit flight from the SVB and other banks, while now that the dust has settled on the liquidity or deposit crisis, the next thing that we need to watch is the response from a credit perspective. So how will banks respond to the instability in deposits from a credit perspective? We need to remember that deposits typically make up a large portion of the funding base of commercial banks, meaning that if there is a source of uncertainty surrounding that funding source, it also leads to ramifications on the lending side. And those are the exact ramifications that we are now slowly but surely gathering evidence of. The last part of the banking crisis, which is probably still, say, a couple of months or even 3 to 4 months out, is the actual economic contraction as a consequence of a lack of credit being made available to the real economy. So first, a deposit crisis, then a credit crisis, and then the ultimate contraction of the actual activity in the real economy. So let's have a look at the status of the deposit flight first, and then we'll move on to the credit contraction that I find likely to occur in the coming months. First of all, the deposit flight is very real. On the latest set of updated numbers, we are now at a deposit flight of almost $1 trillion over the past 12 months. So the amount of deposits held at US commercial banks is now down almost $1 trillion since 12 months ago. This is historical. We've never seen anything like it in nominal terms, of course, but we've never seen anything like it as a percent of bank balance sheets either. So this is by far the most extreme event from a deposit perspective seen in modern banking history. So it of course matters to the credit decisions taken in banks. But why do we see this deposit flight? Well, a lot of focus has been given to the treasury yield relative to the savings yield on deposits in banks. And that spread is still too wide to take comfort in. If we get the chart on money market rates relative to saving rates on the screen, it is quite visible that this issue has been growing over the course of the past, say, 3-4 quarters. And essentially now that everyone's attention is focused on this exact issue in the banking system, we should probably expect a slow bleed to continue, meaning that depositors will remove money from banks and put them into money market funds. The interesting caveat here is that if I, for example, remove a deposit from my commercial bank and park that money at a money market fund, it doesn't necessarily mean that the banking system in total loses a deposit. It depends on whether the money market funds buys an asset from another counterpart with a deposit in the commercial banking system. So if the money market fund that I park my money with buys a T-bill from another counterpart in the system, that deposit will be created when the T-bill is bought from the other counterpart. But if the money market fund decides to park the cash at the so-called overnight reverse repo facility at the Federal Reserve, then the deposit will be removed entirely from the banking system. And currently we see a bit of both. So some money market funds buy assets from other counterparts, but we also see some money market funds parking their excess dollars at this overnight reverse repo facility. So this move from deposits to money market funds is at least a partial part of the reason why we see a deposit flight from the system. And if we look at the most recent set of data on inflows to money market funds, remember that we get new data every Thursday by the end of business. And as you can see here, we are currently still seeing inflows to money market funds every single week. As my friend Jim Bianco labels it, we're now talking about a bank walk, but not a bank run, but the slow bleed continues. There's still an inflow into money market funds week in and week out, and we expect that to continue in coming weeks because the spread between what you're offered in a money market fund and what you're offered on a deposit is still way too wide. And that is why I want to get to what I consider the underlying root cause of this deposit crisis. First of all, an inverted yield curve is extremely toxic for banks. Why is that? Well, the average bank funds itself relatively short on the yield curve, while it lends out the same US dollars further out the yield curve. And therefore, they would typically like a steep yield curve to be able to ride the carry down from the funding base to the lending base. And currently, with a yield curve being inverted, banks will have to artificially create their own steep yield curves by not offering any whatsoever interest rates on deposits. That will keep their own internal yield curve steep while the actual yield curve is inverted. And given that banks therefore do not offer the same yield as money market funds, the flight of deposits will continue as long as the yield curve is as inverted as it is currently, because it's the only way for banks to maintain high margins in an inverted yield curve scenario. And it is very evident from the chart that the exact timing of the yield curve inversion was also the exact timing of the deposit flight commencing. And therefore, in my humble opinion, the underlying root cause is currently the inverted yield curve. And the Federal Reserve is essentially to blame for that. The Federal Reserve can uninvert the yield curve if they want to. Currently, they are not planning on doing it. But I mean, as long as we get this slow bleed from the banking system, the issue grows month after month, week after week. And ultimately, I think the Fed will have to cave in and try to re-steepen the yield curve. So ultimately, my point is that the monetary policy is to blame for this deposit crisis. And I think it is vastly overlooked that the inverted yield curve and the destruction of dollar liquidity via the quantitative tightening program is the underlying root cause for this deposit flight or this deposit crisis. Let's assume that bank credit overall contracts. Clearly, when bank lending contracts, there will be a smaller amount of deposits available in the banking system as well. So that is what you see on the chart here, the amount of broad dollars available to the financial system, the M2 measure, has declined year over year in tandem with the decline in deposits in commercial banks. And this factor is much more important than the factor I showed you just earlier with people moving money from deposits to money market funds. This is probably, say, 5 to 6 times more important than the move towards money market funds, because this is an actual destruction of US dollars occurring due to monetary policy. And I simply doubt that it is possible to continue to destroy US dollars on an ongoing basis from here, unless the Fed truly wants to break things. So why is that? Let's have a look at how a bank's balance sheet is built up relative to a typical corporate. So if we look at a bank balance sheet relative to a typical non-bank on the next page here, we also get the reason why a deposit flight is an ongoing concern for banks. If you look at the right-hand side first, we have the liabilities and assets of banks. And as you can see, deposits typically make up a decent portion of the liabilities of the bank. On the asset side, we have the loans, meaning that if deposits leave, they will either have to decrease the loans or else they will have to decrease the amount of trading assets. Those exact bonds that we've been discussing over and over the past month. For example, Silicon Valley Bank had a lot of bonds deeply underwater due to interest rate increases. Those bonds had to be sold when the deposits left the bank, and they were not able to match the deposits once they were actually sold at market price. So ultimately here, if the deposit crisis continues, lending will have to come down because assets and liabilities need to match. And therefore, the bleeding in deposits needs to stop. And the Fed needs to stop it ultimately. Otherwise, the trend will slowly but surely lead to a clear credit contraction. And I already think we see the first signs of it.
Hi, I'm Raoul Pal, the CEO and co-founder of Real Vision. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you.
But before we get to the data on the credit side, I'd like to show you a few charts on why I think it's basically a wrong assumption to accept the notion from regulators that the regulation being put in place after 08-09 has been sufficient to backstop the issues that we currently see in the banking system, both in the US but also elsewhere around the globe. So essentially two things were implemented after 2008, 2009 to deal with situations like the current in the banking system. First of all, the high quality liquid asset regulation was implemented. And secondly, the liquidity coverage ratio was implemented. And if we look at the reasons why such legislation was put in place, the underlying reason why the liquidity coverage ratio was being put in place was that the regulators wanted to have insurance that banks could deliver in case of deposit flights. So when deposits leave the banking system, the regulators wanted to be sure that banks were able to meet those deposits leaving the banking system. And that is why the liquidity coverage ratio stress tests the bank for a stressed outflow of deposits over a 30-day period. To meet those deposit flights, the next step in the regulation was to implement the so-called high-quality liquid assets. And those assets were mainly bonds, and those assets were designed to be stable so that they could always meet the deposit flight in case of emergency. So let's have a look at whether this regulation has been successful or not. If we go to the liquidity coverage ratio first in Europe, I have a few remarks to make, and it's the same pattern in the US. If we look at household deposits and corporate deposits in a stressed scenario, the world basically looks upside down relative to what regulators expected that it would. If we look at the regulation, regulators expected corporate deposits to be much more stable than household deposits. So the underlying assumption in the liquidity coverage ratio is that you should expect more stability from corporates relative to households. And we see the exact opposite thing happening, namely that corporate deposits leave the banking system at twice the speed of household deposits. If you look at the scales on the x-axis, you see 100 billion on household deposits and 200 billion on corporate deposits in Europe. So corporate deposits are less stable than household deposits. And that is the exact opposite conclusion of what regulators made after 2008, 2009, meaning that this liquidity coverage ratio and the stress tests underlying it, they are based on false assumptions or wrong assumptions. They simply do not pass an empirical test. If we look at the high quality liquid assets that were designed to be able to always meet the demands of depositors, well, if you look at the moves and the volatility in the US Treasury market over the past, say, year or two, it is quite visible that those bonds, they do not offer the exact stability that is needed in a high-quality liquid asset book to always meet the depositors leaving the bank in case of emergency. We've had volatility of, say, 30-40% on long-term bonds, as you can see from the chart here, meaning that you will also have extreme volatility in the mark-to-market of your trading assets that were designed to have high quality in times of stress from depositors. So I think regulation is not as solid as it has been proclaimed to be from the regulators, and that is why I don't take any comfort in these liquidity coverage ratios and high quality liquid asset regulations, since they do not pass empirical tests. They are basically designed based on wrong assumptions. Moving to the credit part of this discussion, I think right now the most evident change of behavior within banks is that banks have taken very, very conservative decisions over the past month or so since this liquidity stress and deposit flight started. One way of showing it is that there is a clear correlation between the amount of emergency lending and the tightness of credit standards in commercial banks. So we've seen emergency lending from the Fed to banks, and typically what happens on the back of that is that banks tighten their credit standards. So it's basically not as easy to get a loan as it was 2 weeks ago or 4 weeks ago. And slowly but surely, that will lead to a credit contraction, in my view, since access to credit is of major importance for credit growth. And if we look at actual credit data, we see the first signs of this credit contraction now. Let's have a look at the bank credit over the past 2 weeks. We've seen a major contraction during the last 2 weeks of March in the credit data from US commercial banks to the extent of, say, 100 to 120 billion, depending on how much the FDIC took out of the commercial banks when they took over the keys for Signature Banks and Silicon Valley Bank. But no matter what, we still see a contraction of credit in the US commercial banking system now, which is, well, the first time since the first months of COVID, and also of a magnitude that seems relevant from an economic activity perspective. When we see a decline of bank credit to this extent, it typically spills over to the overall activity in the banking system and in the real economy after a while. And it is likely to worsen from here. If we move to the chart on credit standards for consumers relative to bank credit, then what we've done here is that we've looked at the relationship between credit standards from banks and the subsequent move in bank lending. So the bank lending is the dark blue here, and we have in light blue the credit standards from banks on a reversed scale. So lower means that we have a much tighter picture ahead for credit standards. And currently, the credit standards as of today would project a decline in bank lending of, say, 6 to 7%, which is quite a decent drawdown size-wise relative to what we've seen ahead of other recessions. So I tend to think that the conclusion is now that damage is done. The SVB was the trigger event for a credit contraction, which will ultimately show up in a recession in the US economy. So what to make of that? I think there are two main conclusions. One, it makes sense to load up on US Treasuries in such a scenario, since the Fed will not be able to hike interest rates, given the sort of underlying root cause being a too tight monetary policy for the banks to cope with it. Second thing is that if we look at bank lending relative to US equity sectors, we've studied a couple of cycles in the beta data here, and no sectors in the US likes a credit crunch. It is as simple as that. So what you have here is every time bank lending drops 1%, how much should we expect the equity sector to decline? And as you note, on the bottom of the leaderboard, we have real estate. Real estate is extremely sensitive to bank lending, while on the top of the leaderboard for the period ahead, we actually have energy. And I've been very negative on energy throughout the year, but I'm starting to turn positive. One of the reasons being that energy companies are not that reliant on cheap financing, since they've actually managed without cheap financing for quite a while due to all sorts of ESG considerations from banks. So, two conclusions. Bonds make more sense than they've done for a while. Second conclusion, real estate is the worst equity sector. Energy is probably the best equity sector given this credit contraction that is likely to be upcoming. Let's have a look at the questions that have been coming in. I want to thank you very much for all of them. So we have a question from Paul. If the deposit flight primarily went to money market funds and it's going to cause credit contraction from banks, what is the overall big picture on liquidity from all of this? That is a really relevant question. As we covered last week in Steno Signals, the emergency lending and these programs being put in place by the Fed on the back of the SVB crisis have actually, on aggregate, increased the amount of dollars available to the financial system. So I think we need to distinguish between the liquidity available for commercial banks and the liquidity available for the real economy. And I still hold the view that the liquidity available for commercial banks will be pretty plentiful for the month of April and probably also for the month of May. Then we probably need to turn around on that view due to a lot of technicalities that we will cover in coming months. But there's a discrepancy between liquidity in the commercial banking system and in the real economy for the time being. And therefore, as we evidently see, also after the inflation dropping again today in the producer price index, markets are doing okay. And I think they will do okay in equity terms throughout the month of April. I'm still long. Question from Joseph. Given your view, I assume stocks will sell off in the second half of 23. Will tech sell off too, assuming that the Fed will start to cut rates? And do you see a retest of the SPX bottom from the autumn? I think it is clearly a scenario that is in play, that we test the bottoms from last autumn. And the driver would be the credit contraction and the lack of bank lending in case. But I mean, given the amount of liquidity currently available to the commercial banking system, I'm not willing to throw in the towel on the positivity on technology and the positivity on consumer discretionary stocks, for example, as of now, because they have tailwinds both from an interest rate perspective, but also from a liquidity perspective. And that is probably sufficient to outpace the issues with bank lending for now. I will, of course, keep you posted week in and week out on the developments in real economic liquidity and in commercial banking liquidity to ensure that we stay on top of asset allocation through this very tricky period. A final question from William: what would cause you to exit the bond trade and outright sell, for example, the TLT ETF, so the long-term US Treasury ETF? I think the game changer would be a trend reversal of some of the forward-looking indicators on money growth. So a credit contraction is, of course, connected to the decline in broad money. So the decline in M2, for example. If we get a reversal of M2, so we get a trough in that, that would, to me, be the first signal that something is brewing beneath the surface a couple of quarters from now when it comes to inflationary pressures. And if we, for example, look at the so-called trueflation inflation measure, which has had a great tendency to lead the consumer price index published by the Bureau of Labor Statistics, the trough in trueflation has actually already occurred, which will likely show up in the official statistics towards the end of the year, in case that this trueflation measure is one we can trust. But I at least trust it more than the CPI index. I think that was all for this week's edition of Steno Signals. Thank you very much for all of the questions. If you feel like you have something that I left unanswered, please leave the questions in the comment section after this, and I will make sure to answer them in writing after the show here. Thank you very much for watching, and see you again next week.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.